Whether the tariff twists and turns even matter for stocks anymore? Let's ask Dan Greenhaus. He is Solus Alternative Asset Management's chief strategist, with me here once again at Post 9. It's good to see you.
Good to be
on this big day. How would you answer that question? Do the tariff twists and turns even matter anymore?
I think they do matter. And I think you see the performance in the market today up almost 2% right now, ostensibly only on the suspension of the tariff, which was just imposed 20 minutes ago. So I think clearly the market's telling you that it still matters. But I think the sentiment underlying that question is valid, that at this point, do investors think that tariffs are contribute to as much volatility in June as they did perhaps in April and May? The answer to that is probably no.
Well, because when the most recent threat came out about Apple and the EU, many of the notes that were passed around were like, this is absurd. This is not going to happen. And the market acted after an initial little fit kind of the same way.
Yeah, but to be clear, I don't know. The 25% tariffs, listen, on Apple specifically, there's obviously legitimate legal questions about whether you can apply tariffs to one company and one product, but which is why you saw the president later amend this to be on smartphones in general. But I think the people who follow Apple have made this quite clear, and I think the numbers look right to me. You're talking about a relatively modest margin hit, 100 basis points, for a company that has margins well into the 30s or 40s. They could handle 25% tariffs. I don't think it would be a death knell for the company.
We're talking about a few $100 maybe per phone. Easy for us to say. But I think my bigger question is...
Well, hold on. That's on top of the retail price, which is not what's tariffed. I think the actual number probably going to be around $100 or less on what would actually be the increase in the iPhone price. Don't quote me on that. Get your boy from Morgan Stanley, who you like having on. That's right, Eric Woodring.
He reiterated overweight again on the stock today. I don't have the price target in front of me, but he's still bullish. I think the greater point is the more we get tariff bark, the less we're going to think there's actual bite. And thus the market does something similar to what it's doing now, maybe not at the same magnitude, but it just brushes it off as a sort of, yeah, right.
Well,
you know what I mean?
For now, that's correct. I think the issue for markets, and this gets back to what we've talked about the last few times I've been on, where my certainly relative optimism has been tempered more recently as we've approached back to the highs. I think that the question now is the right in 2 months is a much more difficult question, because then you're going to start to see, presumably, some impact from these tariffs. They're not going to be as dramatic as people originally thought. They may not be as dramatic as people currently think. And you heard that from Urban Outfitters and Ralph Lauren, Williams-Sonoma, even Deckers, who just reported. The tariff burden is going to be borne by a number of different parties, but you're going to start to see that by the middle end of the summer, and then the question becomes, how does markets react to that?
The other big thing today is the move in yields, right? Yeah. The drop, like 10 basis points or so in yields. You throw up the 10-year, look at that, 10-year, 30-year, what have you. That's a critical part of this story. You couldn't continue to have yields back up, could you? Not if you wanted the stock market to hit a new record.
I don't know. I mean, probably not in the short term. That's for sure. If we continued to move higher, 460, 470, 480, you might have had some equity turbulence, maybe even a meaningful pullback on the order of, call it 5 or 7%. Although whether that's meaningful is a separate conversation. But certainly lower yields in an environment in which growth is holding up and earnings have been strong is better than the opposite. That's for sure. But I also haven't been one who's largely been crying about the 5% on the 10-year. Obviously, the path there, the volatility and the velocity with which that level might be achieved could tell you something about equity performance. But in terms of discounting cash flows, I don't know that 5% is deleterious in a medium-term sense. So while I'm saying you might have a 3, 5, 7, maybe even a 10% decline over the course of that move higher, as long as the economy continues to improve and earnings do what I think they're going to do, call it $280, $300 over the next couple of quarters, then the path for equities is still higher.
Hey, Adam Parker's most recent note was like, you know what? I actually think that maybe earnings are going to be less impacted than many of us, or many, including us, he says, originally feared. Do you think that's going to be the story for many? That the greatest fears about all of this, as it was going to, be such a dramatic hit on earnings, that the market's multiple wasn't going to be defended because earnings weren't going to be good enough, and now maybe that was overblown? Yeah,
listen, that's been my thought from the beginning. And let's go back to the retail companies that we've seen report in the last couple of days. I mentioned Williams-Sonoma, Urban Outfitters, Deckers, I mentioned. Pull up a chart of Urban Outfitters. The ticker's Uncle, Riz, Bussin, Nancy.
Please.
Please, throw up the chart of Urban Outfitters. This is like on the call, they addressed tariffs. It's a thing. But when you look at the stock chart, clearly the stock chart, the investors are telling you, a longer-term one than just today, please, is telling you that tariffs aren't nearly the concern that perhaps people thought. Because all those companies, Williams-Sonoma, Urban, et cetera, again, told you, well, we're not going to bear all of this. The number one thing that we're doing is we're going to start reaching out to our vendors, to our suppliers for what I'll call burden sharing. And you're going to hear a lot more about that in coming days and weeks. And that's the point. That's why tariffs are not going to be as bad, as detrimental to margins, to echo Adam's point, as perhaps originally thought.